Welcome to Tech Money Madness, your daily U.S. stock market podcast, June 25, 2026.
Yeah, and what a day to be watching the tape.
Right. I mean, today, we have a company making memory chips that just reported an 85% profit margin, which completely blows past NVDA, while at the exact same time, everyday Americans are refusing to buy appetizers at Olive Garden.
It's wild.
So today, we're doing a deep dive into an economy that has essentially completely split in two.
Yeah, it really is a profound divergence. I mean, we saw massive, just whiplash-inducing volatility across the indices today.
Definitely felt it.
Right, and you have this this violent collision happening between mixed economic data, these massive tech earnings that are completely redefining growth expectations, and then, like you mentioned, this really sudden shift in baseline consumer behavior.
Yeah, the consumer side is fascinating, but we have to start with a dark cloud hanging over the whole trading session, right?
Exactly. The latest inflation print. So core inflation hit 3.4% in May, which officially marks the highest level we've seen since October of 2023.
Which is just, it's the financial weather report that's driving all these market swings. And, looking at the numbers from today's sources, Wall Street just seems totally confused.
Oh, they are?
We have these different metrics telling us completely contradictory stories.
Yeah, it's a statistical paradox, honestly.
Oh.
We're looking at conflicting readouts. So the personal consumption expenditures price index, the PCE, came in at a 3.4% annual increase for May.
Right.
And the street was bracing for 4.1%. So on the surface, you see that and you think, okay, inflation is cooling off much faster than anticipated.
It's time to celebrate, right?
You'd think so. But then you look at the Federal Reserve's preferred inflation gauge, which strips out the more volatile categories. And that specific core gauge has actually climbed above 4%.
I think the best way to visualize this for you listening is to think of it like looking at a restaurant bill.
Okay, yeah.
The PCE is like the total bill at the bottom of the receipt.
Mm-hmm.
Sure, that total might be lower this month if, say, gas prices dipped for a week or you decided to skip the expensive steak. But the Fed's core inflation gauge is looking at the baseline prices printed on the menu itself. And the price of a standard side salad or a burger is still going up.
That's a great way to put it.
But if the total bill, the PCE, came in surprisingly low at 3.4%, why are investors panicking? I'm looking at the market flows, and instead of throwing a party for lower overall inflation, capital is just flooding into bond ETFs.
Yeah, so what we're witnessing is a classic flight to yield. To understand the mechanics of this, you have to think of bonds as the financial system's shock absorbers.
Okay.
When the stock market gets too bumpy and the data gets this confusing, institutional investors pull their money out of volatile equities and they park it in bonds.
Because it's safer.
Exactly, because bonds guarantee a fixed, predictable payout, a yield, regardless of what tech stocks or consumer spending are doing. Actually, BlackRock executives were quoted today saying the market is sniffing out something underneath these broader economic trends.
Sniffing out something.
Yeah, they're sensing systemic instability.
Wow. Systemic instability sounds a lot like predicting a recession, or at least stagflation. It kind of feels like they're sniffing out the reality that the people steering the ship don't actually know which way the current is moving.
Well, the Federal Reserve seems just as conflicted as the data, honestly. We saw highly contradictory statements from key officials today.
Yeah, I saw that.
Chicago Fed President Austin Goolsbee came out with a very hawkish stance, warning that inflation is simply too high and requires a firm hand. But then, almost simultaneously, New York Fed President John Williams argued that price pressures are visibly easing.
I mean, if you're an investor trying to chart a course for your portfolio, hearing two different Fed presidents disagree on the basic trajectory of prices is terrifying.
Completely.
The entire bull thesis for the first half of this year was built on the assumption that the Fed was going to slash interest rates by 2026.
Right, but if that core gauge is stuck above 4%, those rate cuts just disappear. The cost of borrowing stays high.
Yeah.
And when borrowing is expensive, corporate debt becomes much harder to service, business expansion slows down, and that friction it ripples through the entire economy.
Which brings us to how this friction is showing up on physical store shelves right now. We have this stubborn inflation and incredibly complicated, expensive supply chains. It's no longer just a macroeconomic theory.
No, not at all.
It's actively driving the biggest tech and growth stock moves we're seeing today.
Yeah, the major news today came from two absolute titans of consumer hardware, Apple and Microsoft.
They were the biggest.
Right, so Apple announced larger than expected price hikes on their upcoming MacBooks and iPads. And in their forward guidance, they explicitly blamed ongoing severe chip shortages for the hike.
And Wall Street did not like that.
Wall Street reacted brutally. Apple's stock plummeted today, making it one of the absolute top losers in the entire market.
Wow.
And Microsoft followed a really similar path. They announced they're lifting the price of Xbox consoles, directly citing soaring component costs.
There is just a brutal irony here. I mean, you have two of the most heavily capitalized companies in human history being forced to pass their inflation costs directly onto the consumer at the exact moment when the consumer is feeling the most pinched.
Exactly.
They're betting that their brand loyalty is strong enough to force people to pay a premium. But are they risking total demand destruction by doing this, or do they just have no choice?
They're caught in a fundamental mechanical trap with their cost of goods sold. When physical component costs soar, a manufacturer really only has two levers to pull.
Okay.
Lever one, they can absorb the cost, which shrinks their profit margins, and we know Wall Street will mercilessly sell off any stock that shows margin compression.
Oh, yeah. Wall Street hates that.
Right. So, or they pull the second lever, raise the retail price, and just hope demand is inelastic. Apple and Microsoft are pulling the second lever, but the macroeconomic data suggests this is an incredibly dangerous bet.
Yeah, because I'm looking at the broader retail data from today's sources, and the consumer is just exhausted. That bet seems destined to backfire.
You can see it clearly in the Darden Restaurants earnings report from today.
Right, the Olive Garden parent company.
Exactly. Darden owns a massive portfolio of dining chains, and while they beat their overall corporate estimates, Olive Garden's same-store sales actually fell short of expectations.
And Olive Garden is historically a really excellent bellwether for the middle-class American consumer, right?
It really is. When you look at the mechanics of household budgeting, families pull back on discretionary spending in a very specific order.
Right.
First, they skip the appetizer or the extra drink. Then they stop going out to casual dining altogether.
Right, you eat at home more.
Exactly. And eventually, that exact same financial pressure leads them to decide that their 3-year-old iPad works just fine, and they don't need to pay a hiked-up premium for a new one.
It's a domino effect of delayed purchases. And the market recognized that immediately today. I mean, it's no coincidence that Apple and Wendy's, two massive companies that rely entirely on consumer discretionary income, were both sitting near the very bottom of the ticker today as top losers.
Yep. The physical reality of the consumer economy is contracting.
But this is where today's deep dive gets really surreal. Because while consumer hardware and casual dining are just drowning in physical costs, the companies making the actual internal components, like the silicon that Apple supposedly can't get enough of, are living in a completely separate universe.
It's true. The sheer scale of the divergence is historical. Let's examine what analysts are already calling the Micron miracle.
Yes, let's talk about Micron.
Micron reported their Q3 earnings today. The headline number is a staggering $41.46 billion in revenue for the quarter.
Unbelievable.
But the figure that fundamentally broke the market's models today was their gross margin, 84.9%.
Okay, wait, I have to stop you there. Because an 85% gross margin for a company that manufactures physical hardware is mathematically absurd.
It is.
Micron is actually surpassing NVIDIA's famously high margins right now. I mean, it's one thing to sell the picks and shovels during a gold rush, but Micron is practically charging a toll just to look at the gold mine.
That's exactly what they're doing.
How do they have that kind of pricing power when Apple and Microsoft are crying about supply chain costs?
It comes down to the physical bottleneck of artificial intelligence architecture. Micron manufactures high-bandwidth memory chips.
Okay.
In a modern AI data center, it frankly doesn't matter how fast NVIDIA's graphic processing units are if they don't have the specialized memory required to feed massive data sets into those processors at lightning speed. The GPU is the engine, but Micron's memory is the fuel line.
So if the fuel line is too narrow, the engine starves, no matter how powerful it is.
Correct. And the demand for these specific memory chips from hyperscalers, the multi-trillion-dollar companies building out these massive AI data centers, is insatiable.
Right. It's not normal consumer demand.
Exactly. Micron is not selling to a pinched middle-class family trying to budget for an iPad. They're selling to tech giants engaged in an existential AI arms race. Because of that bottleneck, Micron essentially has total absolute pricing power. They dictate the terms.
And that single earnings report just sent a massive shockwave across the entire semiconductor sector today.
It really acted as a definitive validation signal for the entire AI infrastructure thesis. Wall Street had been getting slightly jittery about whether the massive spending on AI hardware could be sustained.
Sure.
But Micron's 85% margin proved that the demand is still accelerating. So the immediate result was that NVIDIA stock rebounded sharply, pushing back up near $200 a share. By the closing bell, Micron and NVIDIA finished as the top gainers in the market.
And when you look at the most active stocks on the ticker by sheer volume today, it was a three-way tug-of-war between Apple, Microsoft, and NVIDIA.
Yeah.
The entire gravity of the U.S. stock market is currently orbiting this tension between booming AI infrastructure on one side and struggling consumer hardware on the other.
It is a profound structural shift in where capital is flowing.
So while the AI arms race is sucking all the oxygen out of the room, there's a whole different kind of wealth transfer happening quietly in the background, and it's entirely demographic, not technological. The sources for today's deep dive highlighted a few niche sector trends that are fundamentally reshaping the economy under the radar. Let's get into those.
Yeah, so the first one is a really fascinating development in the luxury sector. Despite the immense pressure on the average consumer that we just discussed with Olive Garden and Wendy's, overall luxury spending is actually projected to grow 3% to 7% this year.
But the data explicitly notes they aren't buying, like, designer handbags or expensive watches.
No, they're not. The growth is being driven entirely by high-end experiences, fueled by a demographic anomaly that analysts are calling inheritourism.
Inheritourism.
Yeah. We are in the early stages of the largest generational wealth transfer in history as assets move from the baby boomer generation to their children.
Okay.
Instead of investing that inherited capital or buying physical luxury goods, younger generations are spending it aggressively on premium travel across Europe and Asia.
Oh, wow.
This inherited wealth is propping up the travel and experience sectors completely independent of the broader macroeconomic tightening.
That's wild. But if younger demographics are, traveling the world on inherited money, how are they consuming media? Because the second major trend in our sources today focuses on a radical reinvention of sports viewership and broadcasting rights.
Right. Traditional broadcasters are facing an existential threat right now. Historically, sports rights were the anchor of the cable television bundle. You paid a high monthly fee for a package of channels, and that guaranteed subscription revenue funded the massive contracts paid to sports leagues.
The classic model.
But that model is collapsing. TikTok, YouTube, and other digital platforms are aggressively securing broadcast rights and capturing those younger, mobile-first audiences.
But mechanically, how does that alter the valuation of these media companies? Because a dollar earned from a reliable cable bundle is very different from a dollar earned on TikTok.
Oh, it changes the monetization model completely. Like you said, cable was predictable, recurring subscription revenue. Digital platforms rely on fragmented, algorithm-driven ad revenues and microtransactions. Broadcasters are being forced to adapt to a landscape where attention is incredibly decentralized. They have to monetize split-second viral clips instead of 3-hour captive audiences. It makes revenue far less predictable, which makes traditional media companies much harder to value.
It's funny, we're talking about all this wealth being spent on European vacations and the shift in entertainment, but what about the people who don't have that generational cushion? I'm looking at the data here on retirement funds, and it seems like there is a sudden, widespread panic about outliving savings.
Yeah, the third major trend is happening inside 401k retirement plans. We're seeing a steady increase in the inclusion of annuity options within employer-sponsored plans.
Interesting.
The underlying psychological shift here is a move from wanting to accumulate maximum wealth to wanting to guarantee a baseline income. The data shows that workers are increasingly terrified of longevity risk, which is the statistical probability that they will simply outlive their money, especially with inflation eroding their purchasing power.
Right. And an annuity essentially functions like a private pension, right? You hand over a lump sum, and an insurance company guarantees you a monthly check until you die.
Exactly.
But the sources point out that actual adoption by employees remains incredibly low. Why is that?
It is low because an annuity requires a massive sacrifice of liquidity. People desperately want the safety of a guaranteed income stream, but they're terrified of locking their capital into a rigid contract where they can't access it for emergencies.
Especially right now.
Yeah, when inflation is high, locking your money away feels like a tremendous risk. It's a psychological stalemate for the average retiree.
Speaking of massive pools of capital, We need to look at the corporate shakeups that hit the tape today because some of these executive moves are just staggering. Over at JP Morgan, there was a major succession announcement. They named Doug Petno and Troy Rohrbaugh as co-presidents following the sudden exit of Marianne Lake.
In the world of institutional banking, that is a seismic event. Naming co-presidents is a deliberate move to position a new generation of leadership for the eventual succession of the CEO role.
Right.
It immediately shifts internal power dynamics on Wall Street and sets up a high-stakes proving ground for who will ultimately take the helm of the largest bank in the country.
But honestly, the banking news feels almost mundane compared to what's happening in the retail sector. GameStop's CEO just sacrificed a $35 billion with a BPay package to try and orchestrate a buyout of eBay.
Yeah.
I need a crash course on the mechanics of this. Why would a chief executive voluntarily give up that level of personal compensation? And why on earth would a physical video game retailer want to buy an online auction house?
Right. It sounds crazy. To understand this, you have to look at how compensation affects a corporate balance sheet.
Okay.
When a CEO is granted a massive equity compensation package, it sits on the company's books as a massive liability and a severe dilution risk for shareholders.
Makes sense.
By voluntarily surrendering that $35 billion package, the CEO instantly frees up an astronomical amount of equity and capital on GameStop's balance sheet. This suddenly creates the financial leverage required to orchestrate a massive acquisition or a leveraged buyout.
So it's about clearing the decks to make a massive financial play. But the synergy between those two companies seems completely non-existent.
The theoretical synergy, and it is highly debated among analysts, lies in the secondary market. GameStop's entire legacy business model relied on buying and reselling used physical media.
Right, used games.
And eBay is the world's largest secondary market auction house. If you combine GameStop's physical retail footprint and user base with eBay's digital auction infrastructure, you theoretically create a unified behemoth for collectibles, refurbished electronics, and secondary market goods.
Wow.
Whether that actually works in practice is another story, but the sheer ambition of the capital maneuver is forcing analysts to completely rethink retail sector valuations today.
It's an absolute wild card for the market.
Oh, yeah.
Finally, to cap off today's deep dives, we have a major statement out of the energy sector that ties directly back to our earlier discussion about the physical constraints of the economy. Chevron issued a statement bluntly asserting that there is no quick fix for high gas prices at the pump.
Right.
Now, this statement was issued in direct response to comments made by President Trump, who recently attributed these high prices to big oil actively gouging consumers. And before we analyze this, we just need to explicitly state to you, the listener, that we are strictly and impartially reporting this quote directly from the source material. We do not take sides on politically charged statements. We are simply conveying the viewpoints exactly as they are documented in today's briefing.
Absolutely. And analyzing Chevron's response purely from an economic and mechanical standpoint reveals the immense complexity of the global energy supply chain.
It's not simple.
No, the price you pay at the pump is not simply a dial that an executive can turn up or down. It's dictated by the global price of crude oil, combined with domestic refining capacity, regional geopolitical tensions, and localized distribution costs.
And the refining capacity seems to be the critical bottleneck they're pointing to here.
Exactly. Chevron is arguing that we're facing severe physical infrastructure constraints. There has been years of systemic underinvestment in building new refineries. You can't simply construct a new oil refinery overnight. It takes years of capital expenditure and regulatory approval. Therefore, regardless of policy changes or political pressure in Washington, the physical reality of constrained refining supply means that high gas prices cannot be resolved quickly. The infrastructure simply isn't there to flood the market with refined gasoline.
Which really brings us to the core theme of everything we've covered today. From Apple's inability to source enough chips, to Microsoft's soaring Xbox components, to Chevron's constrained refineries, we're looking at a physical world that is violently struggling to keep pace.
It is the defining economic conflict of our time. We are watching a historically unprecedented split in the global economy.
Yep.
On one side, you have the infinite, frictionless, high-margin potential of AI and digital ecosystems, companies like Micron and NVDA that are just printing money with 85% margins because their products dictate the future of computing. And then on the other side, you have the gritty, expensive, heavily constrained reality of the physical world, where drilling oil, shipping hardware components, and serving meals to consumers is becoming increasingly cost prohibitive. So the question you really have to consider as you look at the markets is this: how long can the stock market sustain a massive rally where the digital economy is booming, while the physical supply chain that supports it is so fundamentally broken?
That is the multi-trillion-dollar question. A digital boon layered over a physical bottleneck. It's definitely something to consider as you evaluate your own portfolio's exposure to these two very different realities. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.